Hello everyone, this is Ted Bauman here with your Friday Bauman Daily video. Thanks to everyone who complimented me on the guitar. That was BMO, and BMO is a Stratocaster. Of course, it is a guitar that I basically put together from various parts, which is something that you can very easily do with Stratocasters. And that concludes the tour of my guitars. If I get any more, I will share them with you. Today, I am just going to wear this shirt to acknowledge all of you who have given me thanks and praise for just being willing to do that on an economic podcast. Today I want to talk about what's going on in the markets. I think everybody knows that we are flirting with correction territory. So I want to start right now by looking at a couple of charts that show the current state of affairs. First of all, here's a chart that shows the NASDAQ 100, which is of course the top 100 stocks in that index. It includes all the heavy hitters, all the stocks that have done so well this year. And as you can see, we are getting very near the point where the 21-day moving average will cross below the 50. We have seen almost a 10% drop. I'll show a chart on that just now. But if you look at the bottom, I think the most important thing to look at is the stochastic, which is the relationship between a short-term average stock price and a longer-term price. And you can see that the stochastic is right where it was back in February and March. So we are definitely in a deeper dip than we have been for most of this year. Similar action in the relative strength index, the next line up, the blue line, you can see that it's pretty low. And then, of course, the moving average convergence is pretty solidly below the moving average, and that's a pretty significant trend against the NASDAQ right now. Now let's look at the S&P 500. You can see that this year we have seen, or rather this summer, we saw a lot of choppiness in the markets during the summer, but then in August and September it has become more consistently down. And as you know, that lines up with just what's been happening more generally, as we saw with the NASDAQ. Now, why is this happening? I think that's the really big question that we want to ask. And here I want to read a quote from a guy named Thomas Saya, who is the founder and president of Sevens Research. I found this online. He says, by giving the market so much accommodation, the Fed has essentially created a spoiled child where nothing's enough and there always has to be more. We're in a mini feedback loop. The Fed is not going to do any more. The market has run a long way. Tech is super overvalued. COVID seems to be coming back, and you get some momentum behind that, and all of a sudden the S&P is down 10%. Where does it stop? From a fundamental standpoint, you could still see another 5% before you get to a level of valuation that makes sense. So essentially, what Tom is saying is what I've been saying probably prematurely for a lot of this year, but I think as a lot of people often observe, eventually your predictions do come true. We are overvalued. We are overvalued because of the Fed. I showed a couple videos ago that the Fed was responsible for about half of the rise in stock prices. Last week, I pointed out that the Fed does not have the ammunition to continue providing support to the markets. The ammunition that it does have is not directly intended to be used to support asset markets. What little there is designed to protect credit markets, capital markets, and right now those are not in question. Whether they come into question later is another story. Fundamentally, everything hinges on federal stimulus. I made that argument last week, and some people said, well, stimulus is socialism. We don't want it anyway. Forget about that. The reality is that the federal government always intervenes in markets one way or another. And what is necessary right now to keep us out of another downturn is for the federal government to spend money. And as I pointed out last week, that's not going to happen, at least not anytime soon. So let's look at the relationship between the current market movements and what happened in the last big drop in the technology sector. Here's a chart that shows overlaid the NASDAQ 100, the orange line, and the blue line, which is basically what this looked like during the period of the dot-com bust. Now, as you can see, there is a pretty close relationship in terms of the rate of rise over the last period just before the 2000 dot-com bubble burst. There was a similar rate. It was a little choppier. There were a couple of warning signs, but essentially it it reached a similar peak and then fell, tried to recover a bit, and then after that it fell big time. Now, I don't think that we're headed for that kind of an action in the market. I don't think we're going to see a big decline like that, simply because unlike the dot-com period, the companies that are achieving high valuations actually produce goods and services that people pay for. And most of them are profitable. Most of them have a lot of business growth left ahead of them. The problem is that their price to earnings ratios are way out of kilter with long-term averages. And if there is any kind of turbulence in the market that raises questions about whether or not those are sustainable, then I think you'll see a movement of reversion towards the mean. Now, for some big companies like Amazon that have a lot of growth ahead of them, that's probably not such a big deal because they will continue to be able to tolerate high price earnings ratios. But for companies that are looking at secular stagnation in their own operations, like I think Alphabet is one, because it's not clear where their next round of big earnings is going to come from, because unlike Apple, unlike Amazon, unlike even Facebook, they're not really branching out into new business lines. And as a result, you have to look at those companies and say, well, at the current price earnings ratios, these companies are overvalued, and we're probably looking at a pullback. We saw a pullback in Amazon already, Apple already, and I think that's because people realized that there was really no reason for that company to be valued that highly given what it produces and sells. So I made a comment in one of my videos that they just sell cell phones. I was being a little cheeky, obviously, but the reality is that a company like Apple is primarily dependent on the sales of hardware at this point. And eventually people get saturated. And if there's a downturn in the economy, they don't replace their phones. If somebody asks, what about Apple's computers? Well, they're a pretty small chunk of their business line. It's really about the phones. And in relation to the phones, it's about the apps. And there's a case where Apple is trying to break into services, trying to get a long tail going in its service segment. But it's already facing huge pushback from companies that are tired of paying 30% to Apple. So that's a case of a company that got seriously overvalued and has started to retreat. It anticipated what I think is coming in the rest of the markets. Now, the question is, where is the money going at the moment? Let's have a look at three indexes. On the left-hand side, we see Microsoft. This is since August down 2.87%. Now, what's interesting here is that you see consumer goods and utilities are both falling. Now, typically, the reason I throw that up there is because these are seen as safe havens. Now that tells us, because they're falling, that people are not taking their money out of high-flying stocks and putting them into safe havens. Where are they putting them? Well, let's look at what's happening in the insider trade, which is always a good indication of how things are going. It turns out that corporate executives in the S&P 500 have been unloading shares in their own companies at a furious pace. They sold about $975 million worth of shares, almost $1 billion worth of shares last week. Right? More than double the previous week. Now, the surge in selling indicates that these guys don't see the current dip as a buyable dip, unlike what they saw back in March, unlike what a lot of people saw back in March, that was a buyable dip. They're not seeing that as a buyable dip right now. They're seeing this dip as one that makes them go into cash. And that is why we're not seeing a rise in companies like Microsoft and in indexes like consumer goods and utilities, which are traditionally safe havens. People are taking money out of stocks. They're putting it under their mattress, figuratively. In fact, here's a chart that shows the insider trading over time, and you can see that that big dip on the far right-hand side going to the negative territory, that indicates unloading of stocks by insiders. It is the highest it's been, or rather, I guess the lowest, the biggest dumping of stocks since 2012. Now, you saw that a lot of these guys bought stock at the beginning of this year. That huge bump that we saw, they had done the same thing back in early 2012 and then sold again. Now, what that tells us, obviously, is that they don't have confidence in what's happening. So what does that mean for the immediate future? Well, I've put together a chart that shows the NASDAQ 100 and the S&P 500, its current CAPE ratio, which is an adjusted price earnings ratio that takes a moving average. A year ago, for example, the NASDAQ was at 24.56. Average price earnings now it's 35.99. That's a 46.5% change above where it was a year ago. That's a huge increase. That means that people are buying stocks not because the companies are increasing their earnings per se, but because they want to own stocks. S&P 500, similarly, 36.74 right now, a year ago, 23.26, a 58% increase. On the right-hand side, you see forward estimates. These are kind of the aggregate of big bank estimates, people like Goldman Sachs and JP Morgan and all those folks. And what they're seeing is essentially more than a 13% drop in the price earnings ratio of the NASDAQ 100 and a 30% drop of the price earnings ratio for the S&P 500. And folks, if that can only happen one of two ways. Either earnings have to increase dramatically and prices don't, or prices have to fall. And I think going into the situation that we have right now with COVID breaking out again in Europe, we're heading into an extremely volatile political season here in the United States. We also are seeing a resurgence of COVID in some parts of the country. We're heading into flu season. The chances that earnings will increase and prices not are very slim. So essentially what's happening is that the big boys on Wall Street are predicting a big drop in stock prices over the next 12 months. Corporate executives are predicting exactly the same thing. That is why they're bailing from stocks. Now, what about retail traders? Well, here's a chart that shows a company called Sunworks. Sunworks has been around for a while. This is a 3-year chart, and you can see that once before it tried to take off on the basis of its, its work. I mean, basically, it makes solar components and whatnot. Well, for some reason, this company saw an increase in price that just boggles the mind a couple of days ago. Things like that only happen if people are in a sense, a desperate speculative mood. Here's a second chart that shows SPI Energy. Again, a massive, so look at that, more than 500% increase in a day. Now, what happened with SPI is that it had, at one point, it was up by 4,154% on intraday trading on Wednesday before it cut back. All that company does is it makes, typical solar power products. It said it was starting an electric vehicle subsidiary. Just saying it's starting it, and bam. So, of course, volume was huge, 350 million shares, almost traded on Wednesday. Today, on Thursday, as I record this, their trading volume is nearly 1,000% above the previous 3 weeks average. Now, what that tells me is that we're in a situation, this is the last legs of this. I think realistically, people are trying to replicate, they're trying to follow the formula that did well for them before. It's not going to work, I don't think, and that's why people are trying to get in and get out on the same day trading. When you get to that point where people are speculating just on the news that a company is planning to think about, maybe making electric vehicles, and they go up by 4,000%, there's something broken. I'm not going to pass judgment on it. I understand why people do it, but it's a pretty dangerous game. For everybody else, I think you need to take heed of the predictions of a drop in price earnings ratios. It's not necessarily the case that earnings are going to go down, but we already know that they are off where they were prior to the pandemic. I think what's going to happen is that prices are going to start falling, of stocks are going to start falling to reflect where we actually are as opposed to where we'd like to be. Anyway, that's enough for me this week. Please remember you can always subscribe to the Bauman Letter. If you ever have any problems with subscription issues, please don't feel like we're trying to cheat you. Just make sure that you send an email to the Bauman Letter email address, and we will make sure that those issues get resolved quickly. Sometimes there are technical issues. We are not definitely trying to cheat you. Anyway, I'll talk to you again next week.